Hello friends, in this video we will understand the cost of carry approach or theory of pricing the futures contracts. There are broadly four theories of pricing futures. Number one, there is an expectations theory which broadly states that the expectations of the spot prices in future will drive the prices of futures contract. Number two, the backwardation theory which states that the producers would like to hedge their risk of non-availability of market or of the price fall, and therefore they may be willing to accept a slightly lower price in future as compared to the expected spot price in future. Number three, the cost of carry approach or theory, which we are going to discuss in detail in this video. And number four, an integrated approach which combines all these three previous theories. So let's dwell into the detail of cost of carry approach or theory. There are certain limitations of the previous two theories that I explained to you. Number one, in the expectations theory, the expectations of the change in the prices of the commodity or the underlying asset in future impact both the spot prices as well as the futures prices. Therefore, spot and the futures prices tend to move in sync with each other. For example, if the gold prices today are 58,000 rupees per 10 grams and it is expected that the gold prices will move to 60,000 rupees, a very big jump in next 3 months, both the spot prices will start increasing as well as the futures prices will also start increasing. So really expectations theory does not fully explain the difference in the prices of the spot and the futures. So we need something else to explain that difference. Number two, if we even look at the backwardation theory, the backwardation theory is relevant only in some specific cases. For example, in the agricultural products, the backwardation theory is prevalent a lot because the agricultural production is seasonal. We mainly have two crops in India, so Rabi and Kharif, and the agricultural produce comes to market at those two specific points in time. So production is not continuous, it is twice a year, whereas the consumption is continuous. We consume wheat, jawar, bajra, sugar throughout the year. So when the product comes to market, the producer or the farmer wants to dispose of the product, whereas the consumer is not in a hurry to consume the entire product. So there is a demand and supply mismatch. That is the reason the producer or the farmer may be willing to accept a slightly lower price as compared to the what we can call as the expected or the right price in future. Likewise, for the non-agricultural produce, the production may be continuous and the consumption also could be continuous. Still, the producers might want to hedge the risk by entering into futures contract for at least some of their production quantity to make sure that they do not suffer losses if the market prices go down. However, that still doesn't fully explain why futures prices are normally more than the spot prices. Backwardation theory, if it works, then the futures prices should normally be less than the spot prices, but it doesn't happen in too many cases. So we need something else that explains what is the reason for difference between the spot prices and the futures prices, and cost of carry theory explains that in every detail. In a nutshell, the cost of carry theory implies that if you want to sell a product in future and you possess it right now, you will be holding that product at least for some time in order to make it available to the buyer when actually the contract has to be executed or the delivery has to be made, which means you must be compensated for holding that asset, that commodity or a product for that period of time, let's say for the period of 3 months, and your costs that are incurred for holding that particular asset must be reimbursed to you. So naturally you will expect that you will be compensated for holding that asset for some time till the future contracts get executed, and that cost is the cost of carrying that asset or carrying cost. Just to work on the previous example that I gave, let's say the gold price is 58,000 today. There is a futures contract that is available to you where you have to deliver the gold 3 months from now. Now you will have to possibly hold that gold with you for next 3 months, which means you will have to invest the amount in holding that gold as well as you will have to safekeep that gold at a proper place. So you will have cost of holding, that is the cost of finance, that the investment that you make for buying that gold and keeping with you, and also the safekeeping cost. So those two must be at least reimbursed by the buyer when he actually expects the delivery in future, and this cost of carry he will embed in the price that you quote to the buyer. If the buyer is not willing to pay that much, then you may not be willing to enter into a futures contract for sale of gold, let's say 3 months from now. I can take another example to explain you what are the components of cost of carry. Let's talk of a futures contract for food grains. Now, food grains are different from the, let's say, examples of gold or let's say Nifty index. Food grains are an asset that will require you to store that asset for some time, which will mean that you have to invest the amount in buying it and holding it. So definitely there is a cost of capital. Now, cost of capital can be different for different players, but usually the cost of capital gets incorporated in the futures contract is the risk-free rate for the short term. Let's say the rate which is almost equal to the 91-day treasury yields in the Indian market. The second component is the warehousing cost. You have to put that food grain in some warehouse and you have to make sure that it is safe kept also. So security costs are also involved. So cost of the rent of that warehouse, or if you own the warehouse, then the capital cost, depreciation, all that has to be a part of the futures contract. Number 3, there is a cost of insurance. You will have to insure that food grain. If something happens, for example, theft happens, burglary happens, there is a fire, then you might lose that stock. But still you will be required to make a delivery of that stock when the future contract matures. So you will of course try to recover that insurance cost also from the buyer. There are other costs, for example, the cost of tracking the food grains, the periodic inspection. There may be a loss in the quality and quantity of food grain if let's say they are stored for 3 months. So all costs need to be recovered from the buyer because he expects the delivery to be in the future. So all these will become the components of cost of carry, and you will ideally load that cost of carry cost onto the expected future price in order to make sure that you are compensated for the carrying of those assets for that period of 3 months. Likewise, in some cases, you may get a convenience yield for holding that asset. For example, if you are holding a financial instrument or an asset, let's say a bond, and you have to deliver that bond maybe 3 months from now. In between, the coupon on the bond may become due and you will get that interest. Therefore, you are getting a yield from that asset also. Now, that yield is a gain for you, which you can reduce from the cost of carry. So the cost of carry will be net of the convenience yield that you might get. So what is the formula for pricing of the futures contract by taking into account the cost of carry approach? The formula is F is equal to S plus C minus Y. That is, futures price is equal to S, that is spot price, plus C, that is cost of carry, minus Y. Y is the yield that you might expect from holding that particular asset. Now let's take an example where you are entering into a futures contract for selling rice. Let's say the quantity is 100 metric tons and the delivery is expected to be 3 months from now. So it's a futures contract for 3 months and for delivery of 100 metric tons of rice. Let's work on some numericals to understand this better. Here, for example, you can see that the today's price for 1 metric ton is 4 lakh rupees, that is approximately 40 rupees per kg for rice. The cost of capital is taken at 0.5% per month or 6% per annum, which as I mentioned is usually very near to the 91-day treasury bills yield in the market in India. That cost will come to 2000 rupees per month. The warehousing cost, let's say, is 5000 rupees per month for storing that 100 MT of rice. We expect that there will be some loss while we store that rice for 3 months, and that loss is approximately 0.5% quantity per month. So that cost comes to 2000 rupees per month. There is a cost of insurance assumed at 1000 per month, cost of inspection periodically assumed at 1000 per month, cost of tracking inventory also assumed at 1000 per month, and therefore the futures contract that you will enter into to make sure that you recover all these costs will be 4.12 lakhs instead of 4 lakhs, which is the today's price for that particular quality of rice. Let's take another example. Let's say we are entering into a Nifty futures contract. Now for Nifty futures contract, the underlying is Nifty 50. So this is a contract for 100 Nifty 50s and the settlement is, let's say, 3 months from now. Now let's say today's price, which is the price that I have taken in the month of June 2023, is 18,800 for Nifty. That is the value of Nifty index, Nifty 50 index on National Stock Exchange. So in this case, we will not definitely have the warehousing cost, insurance cost and other costs as in the example of a rice futures. But we will still have the cost of capital, because if we want to protect from the risk of delivering the Nifty contract, let's say 3 months from now at 18,800, then we'll have to invest and hold that Nifty index for 3 months. So cost of capital for us will be, let's say, at 0.5% per month, 282 for 3 months. The dividend yield we are expecting, because these are Nifty stocks, on Nifty 50 the dividend yield is approximately 1.40% per year. So I have taken that at approximately 0.09% per month. The dividend yield on 18,800 will be 51, because these stocks will in between give some dividend. This has to be reduced. So there is a minus 51 rupees that you will reduce from the cost of carry. So the futures contract price is going to be 18,800, which is what we call as S, or the spot price. Cost of capital, that is C, 282 added to that, minus Y, that is 51 rupees, which is the dividend yield. And therefore futures contract, or F, is going to be 19,031 that will quote if we want to enter into this futures contract. Let's take another example to understand cost of carry. In this case, let's look at the contract for 100 shares of a certain company. Let's say the settlement is happening 12 months from now. It's a long-term contract. Usually these contracts are not available on the exchanges. You might have to use the rollover feature or the spread order feature in order to make sure that you roll over the contract from time to time. But let's assume that there is a contract for 12 months. Another assumption, today's price for the stock is 1,000 rupees. Cost of capital I have taken at same 0.5% per month or 6% per annum for 3 months, which is 60 rupees. Dividend yield on this particular stock is expected to be 2% per annum. That is, if you invest 1,000 rupees, you will get 20 rupees dividend. Futures price for this particular stock will be 1,040. That is 1,000 rupees, which is the spot price, plus cost of capital 60 rupees, minus Y, which is the dividend yield, is equal to the futures contract price, or F, which is 1,040. If we combine the expectations theory and the cost of carry theory, any impact of changes in the expectation in the price of the commodity in future, or price of, let's say, a stock in future, will impact both the spot prices and the futures prices. Therefore, they will tend to move in tandem. However, the cost of carrying that asset for that particular period till maturity of the futures contract will be added onto the expected spot price. Now, let's take a real life example to understand this. In this real life example, I have assumed the carrying cost at 6.5% per annum, which is near the 91-day treasury bills yield in the Indian market at this point in time. I have taken the convenience yield at 1.4% per annum, which is the approximate yield on the Nifty 50 index stocks. Spot price today I have assumed at 1024.70 for this particular stock. Now we will see how the spot prices and futures prices move over next 30 days, comprising of approximately 22 trading sessions. As you can see here, the spot price on day 1 is 1024.70. The prices are increasing and decreasing in the tick size, or the step up price of 5 paisa. So all the prices you will see that they are rounded off to the nearest 5 paisa. Carrying cost I have calculated for each of the days on which the contract is being entered into. For example, the spot price on the day 1 is 1024.70, and if you want to buy and hold this asset, you will incur a carrying cost of 5.37 rupees for next 30 days. Now carrying cost is 6.5% per annum. So 6.5% on 1024 rupees will come to, let's say, approximately 70 rupees. Now that divided by 360 days multiplied by 30 days is the carrying cost on day 1. On day 2, the price is 1029.95, and if you want to buy and hold this stock for next, let's say, 29 days, the carrying cost will be 1029.95 multiplied by 6.5% divided by 360, that is the 360 days in the year, which is normally taken for the calculation of the monthly yield, and then multiplied by 29 days, because from day 2 to day 30 you have to hold the asset only for 29 days. Likewise, we can see that the carrying cost goes down, and on the last day the carrying cost becomes 0, because you are buying the asset in spot on the same day and selling it, or the settling the futures contract on the same day. So carrying cost is going to be 0 on the last day, and that is the reason the futures price as well as the spot price tends to converge towards the maturity of the futures contract. I have taken the convenient yield of 1.4%. Again, same formula, 1024 on day 1 multiplied by 1.4% divided by 360 days multiplied by 30 days, because from day 1 you will get a convenience yield of 30 days at 1.4%. So convenience yield is 1.16 if we acquire that stock or that index on the first day, and if you acquire it on day 2, of course the convenience yield is also will also be less, which is 1.12 rupees, and so on and so forth. So convenience yield also goes down and reaches 0, because on the last day you will be buying in the spot and settling the futures contract on the same day. Now this gives us the futures price on each of these days. On day 1, spot price is 1024.70 plus carrying cost 5.37 minus convenience yield 1.16 is the futures price. So F is equal to S plus C minus Y. That gives us the future price of 1028.90. Likewise, or each of the days the futures contract price has been arrived at. On the last day, as you can see, the futures contract price is same as the spot price, because there is no carrying cost and there is no convenience yield if you buy the asset on the last day in spot and also settle your futures contract on the same day. Now in this graph, I have put the spot versus futures prices together to show you how there is a bigger gap between the spot and futures prices to start with. On day 1, the gap gets narrowed towards the end, and on the last day there is a convergence between the spot prices and the futures prices at maturity. Now let's take a real life example of Nifty 50 futures on the National Stock Exchange to understand how the cost of carry works in practice. Here I have taken the snapshots of the contracts expiring in August 2023. First snapshot is on 31st of May 2023. The next snapshot is on 16th of June 2023. That is about 2.5 weeks apart. So this is the first snapshot taken on 31st of May 2023. For index futures expiring on 31st of August 2023, that is the last Thursday of month of August, these are the prices. Open price is 18,830.60. If you look at the last trading price, it is 18,792.80. Underlying for Nifty 50 futures is of course Nifty 50 index, and that underlying value on that particular date is 18,544.75. So there is a difference of approximately 250 rupees between the underlying and the Nifty price. The futures price is approximately 250 rupees more than the index price on that particular day, which fundamentally reflects the cost of carry, because any change in the expectation of the Nifty 50 in future in next about 3 months from 31st of May would have already been incorporated in both the spot and the futures prices. So the real difference is coming because there is a cost of carry. The theory of backwardation is not much relevant in this case, because it is more applicable in cases like agricultural produce. Let's look at now the cost of carry on 18th of June, which is approximately 3 weeks from 31st of May. The prices of the underlying, that is Nifty, on that date is 18,826. So Nifty has moved up, and the last traded price on that particular day for Nifty 50 futures is 19,061, which is again approximately 250 rupees difference. Now with this, the cost of carry that is reflected on 18th of June is approximately 6.12%. Whereas if you look at the cost of carry on 31st of May, it was about 5.27%. So the cost of carry has now increased as we progressed in futures, but as you go at the end of the contract, the cost of carry becomes 0. I hope with these examples you have understood cost of carry approach or theory of pricing the futures contract in detail. It is fundamentally about the cost that you incur to carry the asset till the maturity of the futures contract. That's why it works differently in case of financial instruments, which typically only have the cost of funds or cost of capital as the cost of carry, whereas in case of certain commodities like agricultural produce, there are many other costs that also have to be incorporated, like warehousing cost, insurance cost, etc. Now with this, we will understand that broadly the differences in the spot and futures prices reflect these three theories, which is expectations theory, backwardation theory, as well as the cost of carry theory. So we'll discuss subsequently in detail the integrated approach, which explains the difference between spot and futures prices by taking all these theories into account. I hope you found this video explaining the cost of carry theory in detail interesting and useful. If yes, please do like this video, share with your friends who might benefit from this, and also comment on this video to let me know if you have any particular queries on this topic. Thank you very much. Take care. Cheers.